My name is Carl Williamson and I'm speaking to you from our London office. It's June 2022. I'm the manager of the Nexus Global Solutions Portfolio and the Nexus Global Dynamic Portfolio. So the Nexus Solutions Portfolio is down 0.9% in the month, taking the year-to-date return to minus 9.3%. The Nexus Global Dynamic Portfolio was down 0.2%, taking the year-to-date return to minus 10.4%. Markets continued to be volatile in May, and having fallen sharply at the beginning of the month, they rallied 6% to finish the month modestly down. The key macro risks of the war in Ukraine, tighter monetary policy, and the COVID situation in China continue to be on investors' minds. A number of stocks still did well in May, including a number of European banks and Standard Chartered, a new position for the portfolio. Commodity stocks continue to perform well, and in terms of regional markets, emerging markets had a better month after several months of poor performance. Fixed income continues to struggle during the month, with gilts losing 3.2%. Having signalled their intent to walk the walk, the Federal Reserve put up rates by 0.5% in May, and markets are now pricing in the same 0.5% rate hikes in both June and July. Hedge funds overall delivered a positive return for solutions, while both property and private equity detracted. Healthy jobs growth continues to support a reasonable favourable outlook for the consumer. The US economy added 390,000 jobs during May, ahead of expectations. The unemployment rate held steady at 3.6%, which is near a record low. Low unemployment is obviously helpful for the consumer. China continued to grapple with the Omicron variant during May, and Shanghai spent most of the month in lockdown. Towards the end of the month, there were some signs that during June we will see some of this released, and on Sunday they announced further relaxations of measures. Markets have reacted positively to the situation in China, because hopefully it should mean that supply chain issues should ease as we move into the second half of this year. Within the portfolio, we've made a number of defensive changes, including adding to utilities and telecoms and reducing some of the more cyclical positions in Europe. Central banks continue to grapple with higher inflation, but are becoming increasingly aware of the risks to growth. Labour markets remain tight, but with real wage growth negative, the consumer continues to be under pressure. During May, there were some tentative signs that inflation may have peaked. However, markets are unlikely to find a durable rebound until they can have some confidence that the worst is behind us and that central bank tightening has been priced into bond and equity markets. It's been nice to speak to you. I look forward to speaking to you in July.